Okay, folks, welcome back. This is the weekly review for week ending April 19th, 2019. Obviously, we'll be going through the economic calendar, general commentary on dollar index, euro dollar, pound versus dollar, and this week's lesson is on back testing and forward testing. Okay, the week ahead, our economic calendar is as follows. On Monday, there are several bank holidays, and on Tuesday, there's really nothing to speak of. This filtered calendar is only showing Canadian dollar, euro dollar, pound, and the US dollar. So if there's other markets that you like to follow, there may be something for it that's not appearing here. I'm only doing this because obviously there's something to talk about for CAD, and CAD is a pair or major with the dollar index, and I only trade majors that are paired with the dollar index. So on Wednesday, we have in the London Open, we have public sector, net borrowing, medium impact. Heavy hitter for next week is Canadian dollar, Bank of Canada, monetary policy report, and rate statement, overnight rate. And there is a press conference, obviously, scheduled for 11:15 a.m. The upside for dollar CAD pair, I think, is something that is noteworthy. So just be mindful of that. I'll hint at that as we get closer to Wednesday by way of Twitter. But for now, just keep that on your radar. Wednesday, we'll probably see a up move on dollar CAD. At least that's what I'm expecting right now. That might change. Obviously there's many different things that could take place between now and then. But right now, it just feels like it wants to go higher. And that means weakness on Canadian dollar itself. So as a Canadian dollar futures trader, we would expect, or at least I expect, weakness on that particular commodity. On Thursday, we have an Italian bank holiday and Spanish unemployment rate, medium impact, core durable goods, 8:30 a.m. news embargo lifts for the dollar-based markets, and Treasury currency report is tentative on Thursday. On Friday, we have advanced GDP for the New York Open, dollar-based, and then we have consumer sentiment at 10 a.m. on Friday. All right, so here's our dollar index. This is a daily chart. We got that up move we were looking for, closing in this entire volume imbalance right here. We want to see it trade higher than what we've witnessed on Thursday. So Thursday we had a nice little pop up. We had small ranges in here, which begat large ranges, and our directional bias, at least my directional bias. On Wednesday's review, I said that we were probably going to turn the tide to a upward drive on dollar. We have buy side liquidity resting above here, and I don't show it here, but just go back in previous weeks, and it should be in your notes also, that the imbalance above these highs on the weekly chart. Okay, I mentioned also on Wednesday that there was a market structure in play that I felt that this would come to fruition on the upside. Now, it needs to continue next week. It can't just have this one little pop up and close in the volume imbalance, because that's a minimum upside objective. We want to see it now make a run for the buy side liquidity up here. This low is an intermediate term to long-term low. Remember, we have looked at the dollar index. Now, this is really zoomed in for a daily chart, only because it's providing me the canvas to speak about the market structure that's most salient right now. If I were to zoom out, which I don't have the capacity to do because I want to use PowerPoint, because if I do that, it makes my videos more concise and more, quicker. Okay, I get through it faster. So if you were to zoom out on your daily chart of the dollar index, you would see that we've been trading higher, and this whole portion of price action is just a consolidation as a part of a larger bullish move on dollar index. So in other words, I'm looking at that, and this is, I got a couple emails, why am I talking about this, and why is it this, and why is it that relative to market structure? So I kind of want to just revisit this real briefly, and then we'll move into the hourly chart. So this low here, notice that to the left of it, we have this low. Why not this low, Michael? Because this low, it's part of this consolidation. Would it be wrong for you or me to note this low and not this one? No. Just my personal taste is I like this one and I like this one. Because if I looked at a lower time frame, this low would be paired up with something in here. Okay, but because I'm not trying to make it more complicated than it needs to be, I elected to use this one. Okay, just know that if we dropped out of a daily chart into a 4-hour chart, inside this low to this high, there's going to be another swing low in here that would pair up with this one. Okay, just know that, just think of it as the 3 candle or 3 bar fractal, okay, or swing point, swing high and swing low. That's what I'm looking at, and how they nest together. And I've done teachings on market structure in the past and free tutorials. So I don't want to destroy you and put you through a long discussion about market structure, but I just feel that it's important to note that this low here, while it may be for the near term an intermediate term low, it may turn out to be a long-term low. So I'm just putting it in record right now. It's being documented that this may be a long-term low, and it may be a significant low for 2019. And if I'm accurate about what may take place, we can potentially see this thing move higher and resume its uptrend and completely disregard its bearish seasonal tendency, which it's already, in my opinion, shown a willingness to do that already. So this low, and then we have a higher low that has higher lows on either side of it here. So if we were just looking at this fractal in price, this low to this low being higher than this one, but they each have higher lows to the left and the right of it. How they nest out provides us a bullish market structure. I don't like to see higher highs, higher lows, higher highs, higher lows like it's taught in retail. That's not what I'm looking at. What I want to see is when we have a low, and a low, and then it's broken up with higher lows on either side of it, and then we have a low that breaks an old low but does not break the old intermediate term low. This right here is going to be energetic, and we see that here. And then we drop down, we create another swing low in here with buy side liquidity. It just was the basis and the framework that I built around on Wednesday's analysis, which led to this move. Okay, so if you remember, the week before, okay, in the weekly review prior to past Wednesday's review, I was telling you all just to relax. Even though that the market's really doing hardly anything in here, I'm waiting for more information. And that's going to happen with you as well. You need to have information to determine what it is that you're going to do. How are you going to engage the marketplace? What is it that you're trying to do? And if I don't have enough information to draw on, then I have to sit still. And I know some of you are really, really impatient. You're excited. You want to learn. You want to be in here looking at moves. You want me to tell you what's going to happen. And I will. But I have to wait until the information comes. And on Wednesday, I outlined it for you. And I told you that we would see most likely a large series of up-close candles making an attempt to get up to these buy-side liquidity pool. It would take something completely unexpected for this to completely fall out of bed and go lower. I don't see that here. Okay, I think that we have more or less the Mueller report around Trump. That was quote unquote good news. It's just there's really nothing in its way to make dollar not want to go higher. And that's really the bottom line. It's an experience factor, a lot there, but I mapped out everything here for market structure so that way you can kind of like get a feeling for what it is that I'm seeing underneath the price action. It just looks like this is a big, massive accumulation, and we might see, a significant run higher, above a full dollar on the greenback in the coming months. What changes that? We have to go below this low now. So that's our line in the sand. Everything's dollar bullish from where we are right now until we take out this low on the daily. Okay? Moving on into a hourly chart. This is that volume imbalance on the daily, that shaded area. Only thing I did was just moved us down into an hourly chart. And this is our SIBI. I mentioned this in the Wednesday commentary, so I'm not going to beat it up again here. It was filled in beautifully here. But we had equal lows with sell side liquidity rated, and then a run up into that volume imbalance. This day is Thursday's price action. It doesn't show Friday because Friday being Good Friday, the broker doesn't show the data. They were, I guess, not operating. But the market rallied up into that volume imbalance. Nice little bullish order block here, traded off of that as well, sent it higher. It just looks really, really nice where it is right now. And I don't want to put too much lipstick on it. And then obviously Sunday we we open up and do something entirely different. But right now everything looks like it's a go for the dollar to resume its upside momentum. Moving on into a 15-minute time frame for the dollar. We can see the equal lows here. Rated that, rallied up, consolidated. Equal lows here, rated that, and then we had a really nice run here. Bullish order block, traded down into it, runs equal highs. And we're going to be talking about this a lot in this particular weekly review because I want you to understand what it is that you're supposed to be doing every single day for practice. Every day, whether it's in hindsight or if you have the opportunity to watch price in real time, you need to be studying it with what I'm going to show you in this video. So at equal highs in here, that was the target for that run here. Price runs into it and also completes the full closure and balancing of that volume imbalance relative to the daily chart. Euro dollar. Okay, so we were talking about Wednesday's rejection block, the fact that we moved up into the consequent encroachment of that as well between the wicks high and the body. And I mentioned that we've already done enough work. It will probably see it trade lower and attack the sell side liquidity pool resting below these relative equal lows. Again, Thursday is here, so we see that happening, and then boom, price makes a run lower. Beautiful, beautiful, beautiful reaction off of a rejection block, which is not something I talk a lot about, but this is a beautiful illustration of it where you actually saw me talk about it and then call a specific move relative to its usage in price action, and then the nice little drop lower. Moving on into an hourly chart. Going forward, I'm going to try, at least it's going to be in my notes to do so, I'm going to be overlaying the cable with the euro, and I'm going to be overlaying the euro with the cable hourly charts only. So it kind of like helps, reinforce the idea of SMT, which is really just measuring professional and institutional accumulation and distribution. So this level in here is that rejection block, and this whole form of run on that liquidity we're going to talk a little bit more about in the 15-minute time frame. But this rally up, notice this right in here, we have this rally here on the euro dollar. This run higher on the euro, remember that. So on the 17th, the euro made a higher high on the 16th, or relative to the high on the 16th. On the 17th, it went higher. Okay, just remember the 17th was higher than it was on the 16th on euro. We'll see this here in contrast because this is the cable, this blue line. So this is an SMT divergence. We have a high, which is directly related to this price point on cable. And then this higher high is not seen with the higher high in cable. It's lower. So there's a lot of distribution. What does that mean? It means that this right here is a suspect rally, and all this is just a run on stops. The same time, we were looking for an up move in the dollar index. Now, we just blended three things together. Market structure relative to the daily chart on the dollar, the SMT, and the correlated SMT divergence with a run into a rejection block on euro. So you have how many confluences of like an approval for an idea that euro dollar is really just creating a Judas swing in here. You have three. There's a lot more to it, and I'll leave it to your personal study, but that's enough. Three things that would support an idea. That's enough for me to warrant a bias or a directional opinion. We'll call it that. So if we're looking for price to go lower, we start now looking for things to be a draw on liquidity, because if the market did in fact trade higher here, okay, if it did trade higher, to go up and run buy stops, okay, or absorb buy side liquidity when the market is predisposed to go lower. That's being shown by the cable being unwilling to go higher, and this run here is not being confirmed with a bearish dollar. So if the dollar's not bearish, it's in fact bullish, this right here is just going to be a run on stops. So we can trust that as a bearish scenario. We can look for the market to go lower. If we miss it, if we miss the initial run here and we can't get involved with it at that price, do we just completely throw it to the side and throw the baby out with the wash? No. You literally have to know in your being, okay, that when we have a larger magnitude price swing that's just about to unfold, the market is going to give you opportunities to get in, and I'm going to show you that today. And that's where you practice. You don't want to say, well, I missed this move, it's already dropped, so let me just ignore this and go find something else and chase something else. That's exactly what retail does. Retail, they skip around from system to system, from one concept to another, to one pattern or another, from one mentor to another, one hot hand on Twitter to another. They don't know what they're doing. I'm going to tell you exactly what it is that you're supposed to be doing each and every day. And you're going to get better at this because of it. Now, I want you to write this down as I say it. You don't have a pen and paper in hand? You have to have note-taking in these videos, because what I'm going to tell you right now is very, very important. Because it's going to separate your success and failure. It's going to be that fine line right between it. If you do not practice what I show you today, I am guaranteeing you, you will never learn my methods. You will never be profitable. You will never succeed with it. Wasn't ready for that one, was it? If you do not practice what I teach you today, you will never be profitable with the mentorship stuff. It won't happen. Because I'm unlocking things for you today. Because there's enough content that's been shown just in month one. And think about it. Month one people are hearing this teaching. It's intended to be so. Because I want you to succeed. I don't want you feeling like I'm dangling a carrot. Okay? Because in fact, I've done this in the mentorship. I did it in the live sessions. When I was sitting down doing live sessions with everyone, 800 plus people being constantly bombarded with 1,000 questions. I actually taught what I'm going to teach you today, but you probably don't see it because you're only worried about the lessons at the top of each one of the monthly installments. Those lessons are core content, yes, but the things I discuss in the live sessions, that's where you're learning mentorship. It's not those lessons at the top of the month each month. They're important. They're foundational, yes. But I had a very heated debate with a member from the initial group last week. And I took it to private conversation on Twitter. And I was greatly offended, at the tweet because it was implying that I was using multiple accounts. And you guys can clearly see I'm using the same account. When I'm sharing on Twitter, that is the same account. It's never something else. I use that account because I'm many times mobile and I'm not at home. I'm out doing things. I'm running errands, taking kids to school. I'm doing all those things. So the conversation was based on an individual that felt like the mentorship isn't really delivering and the setups that I'm doing aren't really ICT mentorship setups. The live sessions, and this is what a lot of folks that were in our first group, like 200 and some people quit the first mentorship because they were wanting signals and they didn't want to learn how to do what I'm teaching you how to do. You all watch me on social media, on Twitter, destroy it every single week, just like everyone else outside the mentorship does. The folks inside the mentorship, you get to understand what it is that leads to these trades most of the time. Today, I'm going to tell you exactly what I'm doing. You would learn how to do what I'm teaching you to follow and price, And it does not matter if you don't want to be a scalper. And it does not matter if you don't want to be a day trader. It's all fractal. Everything that you thought you were confused about or felt like you were wasting your time, that should go away today. That was the whole point of this week. I promised that I was going to put away all of those reasons for you to, number one, want to quit trading. Not my mentorship. If you don't want to be here, I want you to leave. But to get frustrated and say, I can't do this, that's foolishness. Because believe me, there are hundreds of opportunities every single week. If you know what you're looking for, it's there. It's not 500 pips, but there is an opportunity for you to practice and engage and get feedback. And this is what allows you to grow. If we see scenarios like what's being shown here, I talked about it on Wednesday. I said that we would probably see a larger move on the upside on the dollar. That means what for foreign currency, euro and cable? Lower prices. Lower prices. So if we know that that's likely to occur and lower prices are in order, that means we have to turn our attention to what? Where's the market going to go? Well, if the market's going to go higher, like it does here, during a period of time when it's bearish, well, that's pairing orders. Smart money's selling up here at a premium above an old high. Where do you think they want to get out at? There has to be someone willing to buy it, right? Well, where's the easiest place to find that? Below equal lows here, just like I mentioned on Wednesday. Below this low over here, just like I mentioned on Wednesday. And this low here, like I mentioned on Wednesday. So smart money's selling up here with every intention to offload that short position to willing buyers that have buy stops resting below this retail support level. Remember, it rallied up. Someone bought that. They dangled the carrot for the retail crowd. All this running up in here, retail chased that. Where's their stop going to be? Right below these lows. And for anyone that had bought back here or back here, because someone always is long or short, long holders are going to have a stop placement right below there as well. What kind of stop is that? Think about it. What is it? It's a sell stop, right? Well, what are we doing with that? What are we using that liquidity for? Because we're selling it here. If we're selling it here, what's a sell stop down here? How's that going to be counterparty for us? Their short positions have to be covered, ideally in a large pool of liquidity where there's willing sellers. IPTA makes a run to that level quickly, allows that to happen. So there's a partial profit-taking opportunity in here. And does it waste a lot of time hanging around below that low? No, it doesn't. It screams the very next candle below that low. See that? This low and this higher low over here. It rated that liquidity. And then it gyrated a little bit more and then finally slammed down right below that low. So smart money was able to sell short here, buy some back here, buy some back here, buy some back here. That's why I do partials. There's a lot of folks that will argue and say partials don't make sense. Well, I'm going to tell you that's what institutions do because of their volume. So if their volume's so vast and large and they are going to move orders in and out relative to these points of liquidity, doesn't it make sense to do the same thing with your trading? Because you don't know for certain how far, because their pockets are way deeper than ours. They could run this liquidity out here, then come all the way back up, run this high, and come really, really close and use this as a rejection block. Never come above this high. But this whole time, you got to weather that, maybe even get stopped out. Not when it offers this area here for liquidity and allowing you to collapse a portion of some measure on your short position. Remember, we were bearish. We were talking about this area of liquidity. That's the draw on liquidity. When we know that the market has tipped its hand, if you will, as I outlined on Wednesday, that is like the sweet spot of when you're in there practicing because you have a loaded deal. Larry Williams called it like a lead pipe cinch trade where you just kill it with a lead pipe. It's just easy. Very, very, very easy. If you wait until those times occur in the marketplace and price action is aligning with that characteristic, you're going to do very, very well. You're not going to trade all the time. You're not going to have as many trades as you see me showing you on Twitter, which I'm going to dial that back. I only wanted to show off a little bit this month. But you'll have the better choice setups. You'll have quality over quantity. The practicing, though, you want to have as many practice sessions as you possibly can. You want to engage as many times as you possibly can because the intent really isn't about making money. It's experience. I've done tens of thousands of interactions with the marketplace, either by way of a paper trade, a demo trade, live trades, everything from commodities to Forex to stock to options, bonds. I've done all that stuff. So I know what it feels like to be doing these things. Many of you are completely green as what it is that you're supposed to be looking for every single time you get in the marketplace. You're looking into charts. I'm looking for an optimal trade entry. I'm looking for an order block. Well, why? There has to be some kind of a driving force behind that. What's the underlying pinnings of the market telling you? Is there a reason to be looking for those things? And if we work off of a daily chart, which is how I start these sessions every week on Wednesdays and on our weekend reviews, I'm taking you right back to that daily chart. When it's important, I remind you of things on the weekly chart. But most of the time, we're only really focusing on what the institutional order flow is on that daily chart. And that's why I'm always delivering consistency, because I'm taking you right back to the core of institutional order flow. That daily chart is where 90% of order flow comes from on the interbank level. So wouldn't it make sense to have all of your analysis be framed on that? Be mindful of the higher time frame weekly and monthly. Don't ignore those. But they're not going to be salient every single day. But the daily chart is salient every day, because you have daily highs and lows You have previous week highs and lows that you can see on the daily chart. And as the chart is populating for the week, you can see where the intra-week, that means the high or the low that's being formed thus far since Sunday's opening, you can see where those parameters are as well. For instance, on Tuesday at 5 p.m. New York time, what's the intra-week high and low? You can see what that is on the daily chart. They're very salient levels. They're important levels. When you revisit the market profiles, the weekly profiles, and you'll get to that when you get into content later on in the mentorship, the charter members know what I'm talking about. All those things start to dovetail nicely. You'll start getting a better panoramic view of what the market's actually doing. And then as soon as you start seeing things come together, it's that quick. Your brain fires off, okay, this is exactly what it's going to be doing. And then you know. But you're not going to get there unless you know what it is you're looking for. But here's the thing. You're not going to know what you're looking for until you practice enough and you gravitate towards your setup. So you want me to teach you my setup and you want to mimic what I do. I have dozens of setups, dozens of them. When I see one come into a setup based on a condition in the marketplace, bullish or bearish, my mind jumps right on it. I don't wait, I don't hesitate, I'm in there. You're not going to be able to do that right away. It took me 2 decades to get here to do that. What I want you to learn is when there is this much evidence, higher high on euro, cable, not higher high, when the dollar's bullish, that is the unicorn in price action. You want to chase that. You don't want to chase a Judas goat. This right here is a Judas goat. You want to chase unicorns. Unicorns are always going to lead you to the fairy tale, the land of the riches, the everything. You want the storybook ending. This is where it's found. Okay, you want to see that stuff in your price action. You don't want to be chasing price. You want to be looking for cracks in that correlation, because cable should have made a higher high here and it didn't do that. It went right to the points of reference I mentioned on Wednesday. Now, for some of you guys that's been here for a while, okay, Michael, get on with it. Okay, but it's important for you to remind yourself that this is all that it takes. If we can see that on the higher time frame, from this price point here all the way down to this low, there's something we could be hunting. And that's what I'm going to talk about for back testing and forward testing in the lesson. But moving forward, on a 15-minute time frame, we can see they left the buy side liquidity pool up here with these equal highs. Why'd they do that, Michael? Why didn't they come up here and clear those equal highs? Why didn't it run up here on the 17th to clear that out? It didn't need it. What it did was it ran out the intra-week high on Monday. Remember, I just mentioned that. So we created a higher high on Wednesday. Algorithms will all be chasing that as a breakout. Trend following models will see this as a bullish market structure, and it broke out above Monday's high. Well, how'd that work out for them? Not too good. Sell-side liquidity that we mentioned on Wednesday. Sell-side liquidity that we mentioned on Wednesday. And again, sell-side liquidity. And this shaded area actually is a order block. And I'll let you discover where that is. You can see it on the 15-minute time frame if you scroll back a little bit. And I just highlighted that because it ate into that as well. And that's what created a little bounce. And then here's Good Friday. Which, incidentally, I don't believe in Good Friday. I know there's people in here that are atheists or not Christians, but I subscribe to a Thursday crucifixion, so I don't really believe in a Good Friday. If anything, it's a Good Thursday, because otherwise you wouldn't get 3 days and 3 nights in the belly of the earth for Jesus to fulfill that prophecy. Just toss that in there, extra credit. Don't mean to offend anybody. But we had a market protraction here, Judas swing, ran buy-side liquidity right above these equal highs, so it absorbed liquidity here and engineered liquidity on the upside. Breakout artists buying on a breakout, and it was all done on the basis of the manufacturing PMI. Retail and other educators will say, well, this is all attributed to a lack of bids or a lack of buyers. Wrong. Sorry, I don't care who you are, but that's not what this is. It's not that. This is IPTA. Okay? This is going exactly where I said it was going to go on Wednesday. It doesn't take much time to get there. Immediately goes there. You're telling me, okay? You're telling me that there is an absence of any real buyers in here. People are buying all the time based on news releases. Large funds, okay? They're out there all the time putting orders in. Just commerce alone is putting orders in, okay? So believe me, that's a facade. It's an illusion. It's something to explain away what they don't understand. It just makes sense for people to believe that, the market went down because there's a lack of buyers. The market goes up because there's a lack of sellers. When you really strip it down, as good as they make the argument sound to support those things, when you really strip it away, it's nonsense. Okay, it's really stupid. But whatever, let them believe what they want to believe. What we are left with right now, if we get some kind of a pop on Sunday, Monday, because there's some bank holiday business going on, roll over into from Passover, the 15-minute chart left a fair value gap right in here. So I have this on here for your attention, because if we see it run up, or if we see a gap up, okay, on Euro, that's where I'm watching. I'm watching that little area there. So it may poke its head above the 112.60, 112.65 in that area. But I'd like to see if it does that. I don't think it needs to. But if it does, I want to see it reject that and go lower. Moving on into cable. A little less energetic, this pair, compared to what we saw on Euro. Southside liquidity pool right here. That's still our objective. We want to see that trade too. And if we get any kind of momentum below that, an order block should be our downside discount objective. We have a bearish order block in here. We saw this trade up into. I mentioned that as part of the framework for a weaker run into this liquidity pool, and we really start to see that open its wings and descend lower into equal lows here, but the larger liquidity pool is resting in here. Okay, so move on into the hourly chart for cable, and again we can see that strong contrast. Here's that higher high on Euro. False move, market contraction due to swing. Heavy distribution on cable. At the same time that's happening, the condition is bullish dollar, false run on Euro dollar higher. Can we trust bearish order blocks in that situation in cable if it's failing to go higher? You betcha. Bearish order block, sell right there. Bearish order block, sell right there. Down she goes. You don't need every setup. You don't need to trade every day. The last thing I want you to do is be enticed by what you see me doing on Twitter. That's just me building my brand. That's all that is. And it's to inspire you, not to overtrade. I don't want you to think that's what you got to be doing. But if you just do one of those types of trades a week and stop, you're doing better than retail. Because they might have big wins and make 200 pips on something they held on to, but then they give it all back over a dozen more trades after that. They lose, and they erode everything they make, and until they blow their account. I don't want you doing that. I want you to find a bread and butter setup, a comfortable objective to meet every single week, and let your equity grow from that. Because if you do that, you're successful. It's not about how many pips you make. It's not about how many setups you make. It's not about, did you catch that big move that took place? There's a lot of big moves I'm not a part of. I don't care. I just want to have more than I started with at the end of Friday, the week before. If I continuously do that every week, if I have more this Friday than I had the previous week and Friday, I'm going the right direction. And that's all I want you to do. Lower prices are in order. We're expecting that for cable. On the 15-minute time frame, we can reduce this and fine-tune it down into smaller order blocks in here. Nice little bearish order block here. Run lower. Bearish order block. We have multiple opportunities here, here, and here. Now, I want to talk about this because it's important. We have a bearish order block here. And the market goes down, and then it goes right back up here. Why? Why does it do that? It's a reclaimed order block. They're reclaiming that. Well, what if you got stopped out? Well, why did you move your stop? Because it has to move. We have this run to this level here. It's a bearish order block entry. We have equal lows. Did it break that? No. You can't move your stop until you have first profit. Why is that not written in your notebook? It needs to be. Don't move your stop until you get first profit. You don't need to go to break even right away. Reclaimed order block, distribution. Okay, we're going to get down to the nitty gritty, as they would say. Back testing and forward testing. For those that may not know, back testing is when you go back through old data and you look at setups and you study everything in hindsight. Forward testing, or walk forward testing, is where you use the information and confidence and data to support a theory or concept that you studied in hindsight. You start doing it forward as the price is yet to fulfill said concept or pattern. So I want to introduce the idea of utilizing a daily approach to logging what you get by studying. Now, I'm going to supply you a PDF file and an Excel file, spreadsheet, and it doesn't do any calculations. This is a straight little template. Okay, what you want to do when you're looking at price, each day you want to have a bias. That bias is risk on or risk off. Okay, is the dollar going to go higher? If the dollar is going to go higher, we are risk off. If the dollar is going to go lower, we are risk on. That's what this little box is here. That's what you would have. I have the pairs that I monitor, which in this case is the Aussie dollar, Euro dollar, pound dollar, dollar CAD. Now, it can be any pair you want. It can be any market you want. Okay, this is the reason why I'm giving you the Excel template, that way you can change it and fill in whatever markets you want to have. But it's also just providing you a rough template. It's set up over the 4 specific kill zones. Notice that there's no New York there. Okay, because New York I haven't taught, New York closed. I haven't taught efficiently enough for you to have any interest in it right now, but there will be more teachings in the future with it. It's really based on long-term position trading and swing trading. For Asian Open, you're going to be looking for setups. Okay, what setup, Michael? What setup am I looking for? Here's where it is. He's going to give me my pattern. No, I'm not. I'm not doing that. During Asia's Open, okay, it's only a couple hours every night. You're going to look through the majors and you're going to see, is there a pop? Is there a run in the marketplace? Does it create a fair value gap? If it does, the market rallies up. You want to be buying at the top of the fair value gap. That's your drill, okay, or your exercise. You don't need it to go down to the middle of the gap. You don't need it to close the gap. Once it touches the top of the gap on a 5-minute chart. What? 5-minute chart? 5-minute chart. Because what you do with a 5-minute chart every single day is going to be the same thing you do on a daily chart, same thing you do on a weekly chart, same thing you do on an hourly chart, 15-minute chart, a 4-hour chart. It's the same thing. It's order flow. The 5-minute chart is going to give you so much experience. Every single week, you're going to have setup after setup after setup. And not all of them are going to pan out for profitability. This is what the folks that quit in the first year did not listen. Okay? They were all in a live session with me, 800 plus. And they're okay, he's buying it right now. I'm buying it too. Oh man, I'm buying it. Oh man, I'm going to pay for this mentorship today. I'm over leveraging. Then I got hate mail. What I was teaching them was to engage price action. This is what it looks like. That's what those live sessions are in the mentorship recordings. Every single day, that's the actual pantomime of me going through the motions of what you do. So now I'm revisiting that for you folks, okay, in a little bit more structured way. You want to have a log of transactions. Now, initially, you're going to be doing this in back testing. You're going to look at old data, and I'm going to show you how to do that, okay? But then going forward, you're going to practice every opportunity you can. Now, some of you aren't going to be able to do this. I understand that. I understand. But you can do it with a higher time frame. There's no excuse. Okay, a higher time frame chart, like a daily, same thing. Okay, all of that stuff about, oh, I don't want to be a day trader, it doesn't work for me. Well, you should be studying the day trading 5-minute, 15-minute time frames every single day in hindsight, because that's what it looks like on a daily and weekly and monthly chart too. There's no difference. Just because I don't have flout, central bank dealers range, Asian range, deviations, none of those things are going to be obviously applicable to a monthly and weekly chart. But the order flow is the same. So what you want to do is, every day, you want to think about the bias. So on Monday, you check a 5-minute chart during the Asian session. So Sunday night when we open up, going into Monday's Asia, that is what you'll be looking for. Is there a run on price on a 5-minute chart? Does it create a fair value gap? If it runs higher, you're going to buy the top of the fair value gap. You're going to use whatever swing low on the 5-minute chart that was created prior to that run. That's where your proverbial stop loss is. And you're going to look for it to run out the high that it created. And you're going to record how many pips it moves in your favor, how many pips it moves against you up to your stop. You're going to record all those things. The observation here, this is just like each individual one here, you would have this same area for like an observation, what you experienced with it. It doesn't need to be a long novella. It doesn't have to be a wordy thing. Just, it moved 4 pips against me drawdown from entry. Stop never got hit. And it moved 18 pips. Or it moved 7 pips above the high I was looking for it to run. And then it stopped and turned around. Or if it continued on into the next session, which is London Open, you would record how many pips it moved in that. And you do this for the euro dollar, pound dollar, and dollar CAD. And you record everything. How many pips you would have suffered as a loss if it took it out, and if it hits the stop. In hindsight, okay, this is how much you would have lost. And you record that. And you do that in back testing for every one of the pairs that you want to look at. I'm just doing it for back testing purposes. You just want to do the majors. Walk forward testing, you can do anything you want. Whatever pair you want to do, because it's all walk forward. It's unrealized price action. Hasn't seen the chart yet. But you want to do at least a month of back testing before you try to do this walk forward. Oh, Michael, I want to do it now. I want to trade. No, you don't want to trade because you don't know what you're doing yet. 1 full month, 4 full weeks of doing the Asian Open, London Open, New York open, London close. You have to wait for the market to close. Okay? You have to do that. Do it on new data. Not you can obviously get a head start and look at what's past data. Okay? But I want you to follow along with what I normally do every single week. You saw what I talked about for this coming week and in last Wednesday's review. But I want you to go into this with the right mindset. Go into the next 4 weeks only looking at back testing. Based on the things I say about what the market should be doing, anything I prompt you on Twitter about liquidity pools or look at this chart or look at that chart, I'm drawing your attention to something. Let that be a little bit of a crutch. I'm drawing your attention to something. In that way you can study it more based on what I'm sharing here. At the end of the week, you want to be looking at what was the net result. How many pips did you get with the loss or whatever stop out you would have had? What's the net result? Now, you're not trading with a demo account. You're only recording pips. How many pip movements did you have? What was the negative against you when it stopped you out? Okay. What was the most ideal scenario where it moved in your favor? Because you're not trying to calculate in advance how many pips above an old high or how many pips below an old low it's going to move. That's the next stage. Okay. But right now, I want you to get used to looking at price runs because that's what I taught you in month 1, low resistance liquidity runs. Some of you have probably considered, man, it's just not really getting me where I want. I'm going to quit. Okay, quit. Everyone that stays with this finds himself going back to month 1, revisiting month 5, and then the last couple lessons where I give you the flow chart of what it is that you do from one thing to the next. What time frame to the next. What time frame to the next. Top-down approach. Then you can plug and play whatever style of trader you want to be. Because if you understand what the monthly is telling you, well, you can use all of that information down to a 1-minute chart. You don't need it. I don't need a 1-minute chart to tell me what the monthly's implying. It's too insignificant of a time frame. I'm trading volatility and liquidity. For the purpose of backtesting, you're only looking at a 5-minute chart. In the observation area, okay, again, this is just an idea of what you're supposed to be doing each one, not just an observation for the whole week. That's not what this is. Now, you can do that. You can create this as a template for the entire week. But what I want you to do is every individual engagement or exercise that you do for each one of these pairs, and there's 4 of them, it's homework. You want to record the best case scenario of available pips that would have moved in your favor, what your stop loss is when it got hit, how many pips did you absorb. You're not moving your stop ever. It doesn't get moved. So it's the worst case scenario every time when you get a stop out. And it's sky's the limit for profitability. That's how you start with your back testing. You start with that. And you're going to see how much is available every single week if you just relax and start looking at things with your scope on price the right way. But do not demo trade. Do not go in there and demo trade this stuff, okay? I'm teaching you to grow with your perspective. Because if you don't trust what it is that you're learning, you're not going to stick with it. So you need to be motivated. But you need to also overcome fear and greed. You're fearful that you're wasting money. You're wasting money on the mentorship. You're wasting money in the market. And I agree, you probably are wasting money in the marketplace because you're trading before you're supposed to. You don't know what you're doing. You're still learning. So why are you in there with live funds? I tell you not to do that. Don't do that. Okay? Here, I'm telling you to back test and forward test, no demo entries. It's no demo. We're talking about 8 weeks of no demo entry. Think about that. All this is spectating, not speculating. You're spectating. Once you do this, you're going to see how much is available, yes, and you're going to see that you get stopped out. Invariably, you're going to get stopped out of your paper trade, not your demo trade. This is all paper trades. What this is going to do is it's going to show you what it requires you to do to hold these moves, how much time it takes for them to move, and this is what you're recording, your observations over here, for every individual one. So this is what's going in your study journal every single day. You'll have a little space for Aussie dollar. What took place in your back testing? Okay, well, there was a setup on the 5-minute chart with a fair value gap that I went long on. I bought the top of the gap. My stop was at X, and price moved up 50 pips or 20 pips or 30 pips from that price point until that day closes. Okay, so and when Tuesday begins, that's when data stops being collected for that day. We're not using just kill zones. Okay, that's not what we're doing here. We're looking at how much is available relative to those points of entry. Because what that's going to do is it's going to help you frame and highlight what type of trader you're going to be or what you should be. Because your psychological makeup, your personality, all those things are important. They have a great deal of significance for your longevity in this business, because I can't force you to be a day trader if you don't want to be a day trader. And I can't force day traders to be position traders, just like I can't be. I'm not comfortable being a swing trader because it's too much time in the market in the same position. I don't feel comfortable doing that. I want velocity, and I want to be able to turn that equity over faster and faster and faster and faster. So once we complete a day, you're going to put your observations about what it is that you saw take place for that individual day and that individual entry on a paper trade. Then, at the end of the week, you want to record what the net results were in terms of pips. Was it a net gain or a net loss for every individual one? Now, what this is also going to do is it's going to help you pick your favorite pair out of these majors. Now, I'm not saying that you're going to stay on that the rest of your life, that it's going to be the only pair you should trade or the only market you should trade. But right now, in the early stages of your development, you need to find something that you are 100% backing emotionally and psychologically, that this is what you should be following. This is the markets that you're going to trade. You like this market. So if you know by studying 4 weeks past data, okay, then you're going to study 4 weeks of forward testing. You're going to have 2 months of data. With those 2 months of data, you're going to be able to pick your favorite pair, and you're going to have a better idea of what type of trader you want to be, because you're going to see how much pips are available based on using this entry, based on the kill zones. Kill zone is the basis of the entry, but it's not the basis of the length of the trade. Okay, you're just going to record the total amount of pips from each individual pseudo entry. Now, for those that are really gung-ho about studying, you want to also include in your weekly observations how many pips for the week it moved from individual daily entries. For instance, if you went long on a fair value gap on the Eurodollar on Tuesday in Asia's open, for the entire range of the weekly range, how many pips did it move from that fair value gap? Okay? You want to collect as much data as possible. And for some of you number crunchers out there, can have a field day with this. And I'm actually looking forward to some of that being done in the ICT Mentorship forum. I would like to see the charter members be able to post that and share what their observations have been. Because if you're not doing it, you're not going to learn. I can't do this for you, but I did this for years. Not 8 weeks, not 4 weeks of one thing and 4 weeks of another. I did this for years. And it wasn't until 2 to 3 years of me doing it, I felt comfortable. Now, mind you, I was taking live trades at the same time, but when I was losing, I would use that information and try to digest what it was that I was doing wrong. What I actually learned as a result of all that is if I just would have submitted to just doing this alone and paper traded, not even speculated with a demo account, I would have been able to refine my model based on the data that I collected. See, you look at the chart and you say, okay, yeah, I can see where that order block moved up here, and I can see where that kill zone made a move here, and that's about as far as you all go with it. And that's the truth. But the ones that are really succeeding in the mentorship right now, they're doing things like I'm showing you here. They're studying the data, the moves, the points of which the time and day and kill zone starts to move. How much drawdown does it absorb? Is there any drawdown? When you have that data, what it does is it keeps greed in check, because you're greedy. You want 300 pips a week, whether you want to admit it or not. Yeah, Mike, I know. I believe that 25 pips myth. Okay, that's our mantra. 25 pips a week, and we're good. But you really aren't subscribing to the 25 pips, are you? You want 300 pips. You see pound yen moving all over the place. You're seeing these astronomical price moves in dollar CAD in recent weeks. Okay, so you're seeing things that are making you want to chase more than you need. But when you study 4 weeks of back data like this and then study forward 4 weeks, you're going to see there's a random distribution. And as I use the word random, there's a random distribution of opportunity that overperforms or outperforms other opportunities. And that is going to be our next level of studying. But I need you to do the 4 weeks back testing and then 4 weeks forward testing. And then we're going to come back into this exercise. And it's going to help me show you where the better setups occur. The ones that I really wait for every week. Not the ones that you see me scalping on Twitter. The ones I'm really sitting back and waiting, like I showed you last Wednesday. Last Wednesday when I outlined the dollar, that's that one good setup for last week. That's what I was waiting for. The previous week's weekly review, I told you, I don't know what's going on. And I reminded y'all, just give me some time. Because I'll know when it's going to do it. But I have to have the information first. You will understand and appreciate that when you do what I'm explaining to do here. And you're probably thinking, man, I ain't doing this. This is stupid. This is a waste of my time, man. I'm supposed to be looking for SMT diversions. It's not all this. You're going to go into these bigger moves. Once you see it in the numbers, the data, where these big moves are occurring, that's the highlight. That's where you go in and start studying. What were the signatures there? Yeah, and that's when we get down to the brass tacks. Because that way, you'll be able to make a whole lot more sense out of the price action models when you get into the charter members and those individuals that are in charter member. It will really start popping off at the charts when you start putting this type of work and data behind your analysis. Because you know exactly what you're looking for. You're not going to be enticed to do other things. Maybe you're not thinking that you're in that situation anymore. Maybe you've already settled on your style. Okay, and that's good. But this is still going to help you. Okay, it's exactly what I should have done in the beginning. I should have done this. I should have absolutely done this very thing, but no one told me exactly what I'm supposed to be doing. Now, granted, backtesting has always been around. Oh, you should be backtesting bull flags and head and shoulders patterns. And I guess to some capacity you can. You can do that. But to me, order flow, there's millions of examples of that over the course of a year. Okay, you can find so many more setups. How many head and shoulders are you finding? How many profitable bull flags are really available? Okay, there's bull flags all the time, right? Granted. But fair value gaps occur all the time because it's an imbalance. And IPTA will go back to seek that, to fill it. We don't want the middle of the gap. We expect it. We don't need the full gap closure. We expect it. We want to get in. So you're going to be entering early all the time. Wait a minute. So what you're telling me is when I look at your charts and your entry points on Twitter, you're always a little bit early. Hello. Now you're getting it. I'm not trying to teach fair value gaps and imbalances like for free. I'm not trying to draw that much of attention. That's only for mentorship. So I always fluff up and get as close as I can when I'm sharing my live examples on social media. Because I'm stupid. I know if enough examples were placed out there, people say, wait, he keeps getting in here when it does that. Hello, there it is. And they got one big major component. The fair value gap that exists in optimal trade entries and bearish order blocks, that's what makes it high probability. That's the secret sauce. That's the thing that makes me know that I got a good setup. And you didn't write that down in your book, did you? Again. I am giving you so much while I'm talking over top of this static image on PowerPoint. But you're probably dropping off and falling asleep. And you can't fault me when you don't get it, because I just gave you a ton of insight. Exactly what to do to get exactly what you expected to learn from this mentorship. Because I told you I should have done this, and I could have shaved off 6 years of my learning curve. 6 years of it. So let's go into the charts real quick, and I'll give you a feel for what it is that you're supposed to be looking for, and then how to record the data in this spreadsheet. All right, so we're looking at a 5-minute chart of the euro dollar. All right, here's Asia. Okay, Asia in here, and we have a fair value gap right there. I'm going to zoom in. All right, so we have one single pass right here. This portion of price action right there, we want to be buying at that low and put a stop down here. So you would buy as it hits right in here, and your stop will be right below the previous low. Okay, whatever swing low exists prior to this gap. The gap is minor. It's very, very, very small, but it's still there. You'd buy at the top of the gap, which is this low here. Buying that, you want to see how much does the market move from that price point until the day ends. Well, if we zoom out on the day, buying right here, price rallies all the way up to this level here, creates a double top, then it comes all the way back down. Does it stop out? No. It rallies again all the way up here during the London Open. So from the entry to the high, or the session high of London Open, it trades up to 113.20. So about 15 pips or so. So 15 pips, and then by the end of the day, it's closing here. It stops you out during New York Open. So you have a rally of 15 pips from the Asian Open to the London High, but then it creates a stop out in New York. So you would record 15 pips available up to London Open, session high. During the Asian session, you have a high of 13, which is about 8 pips. So it only moves 8 pips for you from that entry, but it creates a stop out at your stop, at the very low of the stop. So if your stop is 1 pip below the low, it's 113, big figure. So it's 5 pip loss for the day, but 15 pips available. So what is it teaching you? We have equal highs here, where your observations would be recorded as getting in. It gave me 8 pips profitability, okay, but not enough to take a partial on, because you want to at least take 10, 15 pips. But it offers you 15 pips in London Open. So you could take a partial there, which would be above these equal highs. The equal highs, high is 113.13, and then we have the high in the London Open, if I can get it to pop up here, is 113.20. So an additional 7 pips or so. but total 15 pips from the entry here. Yes, you had some drawdown in here from your entry. The drawdown is 3 pips. But you want to record how much time it took from the equity high you had on the day from your entry, and then you draw down to negative 3 pips, but no stop out. Okay, no stop out. Now, admittedly, depending upon on some brokers, that could have stopped you out based on a spread. They could widen the spread and take you out. But just for the purposes of using the data, you're not getting stopped out here. You're just recording it. And you can admit there's nothing really barn burning here. I'm not cherry picking. I'm not form fitting. I'm just showing you this is how you record in your observations. So the day closes here, basically just below your entry point. So it was a wash unless you took first profit at 15 pips above your entry in London Open. Had you done that, even if it stops you out, you had what? A positive transaction. And what does that what's that reinforce? Number one, it reinforces your focus on a run above equal highs. It offers me an opportunity to get out. Okay, well, right above here, the high was 113.13. So if we just take 5 pips above that as a partial, we could have got out with 10 pips, hunting 10 pips like that. The next day, in Asia, price declines. It starts to decline in here. We have a fair value gap right in here. Price drops in here, only single candle down. Price drops a little bit further, then comes up. We could sell here, which is also a mitigation block. Not trying to confuse anybody. You can go short here with the expectation that we're going to run below previous day's lows. Previous day's low, right in here. That low is 112.97. We look for a 10 pip run below that. We'd be looking for 112.87. Doesn't give it to us in Asia because we go down to 112.92. Then we have drawdown all the way up to what we would have been a stop out. If we would have used this high here or here, we would have had a stop there. Now, right away, this is already making you feel uncomfortable, isn't it? Because you want, give me an entry that makes money, Michael. I don't want to have losing trades. I don't want to have any kind of drawdown. I don't want that stuff. This is how you learn how to find the setups that offer that. Now, there's nothing guaranteed you're going to get in a trade that makes profitability and no drawdown. I'm just saying that you're going to see signatures that repeat over and over again on the ones that do offer it. But you cannot learn that until you engage with this. So again, on London, we have price drop down. Nice little run in here. We create a gap from the candle's low here. Only sell side is offered in here. On this candle here, right at the top of that candle, we would sell short there. We're not trying to get in the middle of the gap. We're not trying to get the full gap closure. You sell short right there. What are you looking for? You're looking for a run below this low and below this low. Notice we're only trading inside the kill zone when it creates an imbalance. You could have used this one as well in here. We got a fair value gap right there. You could be selling short there, and your stop would be here, and you would be stopped out there. And that would be your engagement for Eurodollar for one session entry for London Open. But it creates another one here, selling short here, targeting this area for liquidity, targeting this area for liquidity. Okay, and the low here on the day is 112.92. 10 pips below that would be 112.82. The low in London session is 112.79, and that's enough to get your spread. So you would have gotten the 10 pip run below here. So now watch what happens. You have a scratch essentially here unless you took partials here. Okay. And because we're not trading it, we're not even demo trading it, there is no partials being taken. You're recording the likelihood of the possibility it could have happened for you. You could have took partials and it would have helped you that day on Monday. On this day, you have a stop out here. And on here, if you traded this one, you have a stop out. Okay? You're getting stopped each time. So you have nothing really to talk about on Monday. You get stopped out 2 times here on your practice session. Right away, anyone else would be like, that's it. I'm not doing this anymore. It's just stupid. I'm looking at breakers. You have to keep doing the same thing. You're going to trade fair value gaps in the direction of the imbalance. Price declines quickly with these 2 candles, creates a fair value gap. You sell short here, and boom, right away from the entry, which would be on this candle's high right there. That's 113.09. So your entry is 113.09. Your stop would be 13.14, which is 1 pip above the high. Okay, or you can use this high here if you want that. I would use this one personally, but the high here is still 113.13. So it's still 113.14 is your stop. The entry again is 09, and it runs to your full 10 pips below previous low, session low of Asia, which is here. Okay, so I haven't made it apparent to you. What you're looking for are previous day's highs and lows, runs on liquidity, and previous session highs and lows. Okay, that's what we're using here. The kill zone indicator down here, probably somebody go, oh, I hope you give us that. It's not important. You just need to know the times of the kill zones, and all you're doing is focus on the imbalances that occur. So we have a nice run here over 20, well, about 20 pips. We'll call it that with a spread on both sides. So you have a 20 pip run. So right away, you lost here, and you probably had a scratch here, but now you're ahead on the week just for Euro. Okay? Moving into New York. We have a fair value gap in here, and it begins, or the bottom of it is here on this candle's high. So 113.05 is our entry. If we ever get up to that price point, it does so here. Now, it's between the kill zones, but, study it anyway. If I can get this to pop up, be great. I got to get that thing out of there. This candle is the same price as that line, and it won't let me get it. Alright, so this candle's high is 113.05, so we got the actual fill. So 113.05, and then what are you looking for? We have a session low in New York, which is here. So we're going to see if we can get a run on liquidity below that. So at 112.91. So if 13.05 is our entry, we want to see 10 pips below 112.91, which would be 112.81. The low comes in at 112.79. Doesn't quite get it, but we have double bottoms or equal lows here. That same component of running liquidity that creates it again. Again, this is a 5-minute chart. Everything's happening on a 5-minute chart. We're not considering anything else. The low is 112.87. Okay, so 112.87. Anything below that, 5 pips, 10 pips, if we get it, we want to take profit. We have London Open's low as well. We want to try to see if we can get below that. That is, again, 112.79, and this low is 112.78. So we ended up getting it later in the day right there. So we did get this run out here. We did get this run out here, relative equal lows. It happens right there. So again, you have data. what's this low running out? The London close. That's the low on the London close. So if you have a late New York continuation, that's what you focus on right there. So right away, we've made up for Monday and the 2 losses here right away with this several shorts. We have an imbalance here. Okay, a fair value gap in London close. It starts at the top of this candle. The high is 112.88. So if it trades up to that, which it does here, we could go short. So 112.88 was definitely filled. Our stop would be above here, and we would be looking for a run below this low. We get it here. It does not happen in the form of 10 pips, not even 5 pips, but it does run it out. So what has it done? It's teaching you low resistance liquidity runs on liquidity. Lots of setups just in this one day. And that's all I'm really doing many times on Twitter. All right, so now we have Asia. We have a run here. There's an imbalance in here, fair value gap here. There's a fair value gap in here. The fair value gap from here to this candle's low. We're above it coming down. Again, we're using the top of the gap, not the bottom of the gap like we did on these examples over here, where it's the bottom of the gap and we come up to it, we trade to it that way. We're using the top of the gap to buy at. So when it trades to this candle's low is 112.97. It trades to it here, 112.97. We would go long there, and all the way up to London Open, record how many pips that is, up to this price point, 113.23. We also have a run here. Fair value gap right in here. If price trades down to that, we could be a buyer at the top, which is here. Stop would be below here. We get a little bit of a run, but we also have this fair value gap. So now you have 2 of them. You record all of it. It's a separate transaction. Okay? You're going to see the difference between this one, or I'm sorry, the one buying it over here to here. And now, even though we can't do it in the States, we can't hedge, you still want to record this because it's a fair value gap. Fair value gap in here. We're going to be selling short at the top, at the bottom of the fair value gap, or the low end that creates the gap, one single candle. It's rebalanced up to this price point here, and I'm trying to get the wrong end of the candle to show me what I need to show you. The high is 113.15, so if it goes to 113.15, which it does here, we would sell short with a stop above here, which is what we have. No stop out. Price runs what? We're looking for the run below the double lows during London Open. We don't get it until then. Okay? And then the low on that is 113.03, so 112.93. 10 pips below that. We have 112.90, so we did, in fact, get 10 pips below that. And also comes back and fills in this volume imbalance right there. So we have another imbalance in here and a fair value gap right there. One single candle that's bracketed by a wick here and a wick here. So our eye goes right there. The bottom of the gap is where we sell short there. Stop above here. Running below this low would be our objective. We may have gotten stopped out here, so we'll call that a scratch. It's a stop out, whatever that loss would be from our entry to here. And using this, I didn't mention the stop loss. From here, if we're buying this, we got to use a stop loss below the swing low, and the swing low would be this low right here. Why that one, Michael? The candle before it. The low is 112.89. This candle's low is, well, it's a pip head higher, or lower rather. And then this is a higher low too. But this would be where my stop would be right below that. We do have a fair value gap in here, but you would be stopped out there. I would record that one as well, show that as a loss. And then, but that would be at the tail end outside between the kill zones, but still nonetheless record it. No real fair value gap in here. This one, selling it right above or right at that candle's high here. And it would fill in the very next candle, and you would put a stop above here. It shows it as a stop out. Record that. Now I can already tell some of you are like, man, this doesn't make any sense. Why would anybody want to do this? This is exactly what taught me exactly what you see doing on Twitter, and what leads me to believe the market's going to do what it's going to do. Because everything I just showed you here, if I'm using imbalances as a means of analysis for my higher time frame, daily or weekly or monthly, and it's not the only one I use, but it's very, very, very efficient. It helps me dial in with really tight entries, and when I'm right, the stops don't ever get tagged, and the drawdown is very, very minute, if at all. So if I find the setups that occur in the choicest of conditions, then I've paired the best entry style, the rebalancing done by IPTA, at a moment when everything is in concert with one another. Then I get blue ribbon results. It's just unbelievable. So moving on into the 18th, we have euro dollar during the London Open. Price drops down efficiently or quickly here, comes back up in here. No real imbalance or fair value gap dimension of in here. Then we have this big void. Price runs away, and then we create another one here, right in here, and this is a fair value gap, and you can sell short at this candle's high, 112.58. And I already know what some of you are thinking. Why is this a fair value gap, and why am I looking at this candle's high, Michael? Because this single candle right here went down only. The very next candle opens and trades up a little bit, so buy side was offered to rebalance, but only up to that price point of this candle's high. That candle's high right there. So at 112.58, when it's down here, if it trades back to 112.58, I'm going to sell short with a stop above this high, with the expectation that I'm going to try to reach 10 pips below this low. Because everything about IPTA is rebalance, then expansion to new liquidity. Expansion, imbalance. Rebalance, expand to new liquidity. Oh, how about that? And that's all you need if you're going to be in there on an intraday basis. Bias will help. Risk on, risk off, it will help. You will see that it really helps you on the right side of the marketplace. But it's not necessary, because you can see what the market's already doing, because IPTA's in a roll. It's taken off. It's going one direction more than it's going another during the kill zone. Market drops off in here. No real fair value gap to mention, but it's so tiny I wouldn't even mention that one. Nah, nothing in the New York session here. And London close, we do have a fair value gap right in here, which would fill here. So you'd sell short on this candle's high, 36, and the stop would be 40. So we're only talking about 5 pips stop loss, and we're expecting the market to run seeking lower liquidity and not get stopped out. And we went into Good Friday, which really didn't offer much at all. So that's the euro dollar, and that's how you would record it, where your entries are, what the total profitability was. And then what you want to do is go back and zoom out and refer back to all of those entry points and relate that with the total range of the week. And what that's going to do is it's going to give you tons of information, data that you can chew on and study and say, okay, when the market's done this on this particular day of the week, it usually, for this pair, is offering me X number of pips with X number of drawdown. And I already know some of you are saying, well, just because it does that one time or two times, it doesn't really warrant enough of a belief. And I'm going to tell you that's not true. Because when you start seeing the raw data, and what's available to you, then you'll know what you're going to go in looking for the forward testing, walking forward. So going forward, you're going to know, okay, looking at the last 4 weeks of past data, which you have to wait for. So the next 4 weeks, all you're going to be doing is looking at previous session movement. You can use the last 4 weeks, yes, but I don't want you using that for your data. Okay, and then once you do that, you'll have information that you can say, okay, this is what the results were for this pair and this day, and I know that this pair outperformed on a consistent basis this day of the week, this kill zone, and by this much, and how much drawdown did you incur or would have incurred. When you start looking at like that and see what's available, then you will understand and appreciate. When I look at the weekly range, I'm not just looking at 75 pips. There's a lot of setups in there that I just ain't in front of my chart looking for. If I want to sit in front of the chart and just go nuts, I could easily pull 500 pips a week. Easy 500 pips a week. Trading just euro and cable. Maybe Aussie, maybe dollar CAD in there, once in there somewhere. But I can pull 500 pips every single week if I wanted it. I don't need it. I just want to get one good setup and be done. I'm past all that. And I want my students to feel no rush, no impulse, no enticement to go in there chasing 500 pips, because you're nowhere near ready for that. Okay, it took decades for me to get to that point where I can admit to you with no embellishments that I can do that. And if you just count the pips I did this last couple weeks, it's not hard to believe. So, just in quick passing for cable, here's Monday. And let me apply my kill zones real quick. And we'll just briefly walk through it real quick for cable. All right, so we have a fair value gap right in here that would fill you on this candle's low. That is 113.09. It trades down to that low here, 113.09. So you would be long. Obviously, you factor in the spread. And then what do we have here? Equal highs. So equal highs, the highest high in there, we want to go at least 10 pips above that. 131.05. The high in New York, which it expands up into 131.18. So 13 pips. Again, not crazy pips, but it's still pips. We have a nice drop off in here. We have a fair value gap right there that would be filled on this candle's high right there at 131.06, and it fills on this candle there. So you'd be short here, stop above here, no stop out, running liquidity below the New York Open's first objective, and we have relative equal lows, so we know that there's an expansion that could occur. And also we would look back at London Open, where the low is for that session. So the liquidity would be the objective for that. You can clearly see we don't really get to it. It rolls over into the next day during Asia, where it creates another run lower. Fair value gap is one single candle, and this candle here is where you would go short the high at 130.93, which is the very, no, not, that's two candles later you would get in, because it sells it next one at, come on, the high at 130.94, so at 93 it fills you. So you'd be short here, stop above here, equal lows, liquidity run, low resistance, reaching down. The low on the run goes to 30.78. The low on the previous day's London Open, come on, is 78. So we don't breach the previous day's London Open low, but we do get below here. The number of pips, no stop out, no losing trades yet. And then in the London Open session for the 16th of April, we have no fair value gap there. We do have one here. So we have a drop down. This candle's high. If it trades back up to it, which it does here on this candle, it goes showing short with a run below Asia's low, stop above here. We get it there. So add your pips up there. No real fair value gap to mention in here. In the rest of London. In New York, we have fair value gap right here on one single candle. No, it actually isn't. I'm sorry, it's not one. So we don't have a fill there. We do have a fair value gap there, and we don't get a fill. And we do have a fair value gap here, but is that in London? I'm sorry, New York. It's at the end of New York. So it probably wouldn't fill until the overlap with London close. But either way, we'll say there's an entry here on a fair value gap, filling it at this candle's high. 62, stop goes to 72, so 11 pip stop, a run below New York low. And again, that fill is 1306. And it runs to 3042 and 3047. So it goes 5 pips below, interestingly enough, below the New York open session low. And then continuously rolls lower into late New York close, 130.38. And again, basically almost 10 pips, because here's 47 and then 38 here. So we almost got it, but then we got it on Asia the next day. Okay. So again, what does that teach you? Keeping partials on will allow you to get your objective, but pay yourself below the equal lows, below the session lows. Pay yourself something. When you see me say pay the trader on Twitter, you're going to see that's exactly what I'm showing you here. This is not contrived. I'm not trying to blow smoke up your rear ends. I'm not trying to give you something, to chase your own tail. This is exactly what you need to be practicing every single day. Now, here's the thing. On larger time frames, you just don't have the kill zones. You just have to rely on the institutional order flow and where the fair value gaps exist, and then run the old highs and old lows out. All right, so we have a fair value gap right in here during London, and that would be filled in New York. Stop would be above this high or this high. We'll say this one here. We might have gotten stopped out, to be fair. I would probably say I would got stopped out there, even though it does take the equal lows out. It does sweep that. Creates all kinds of equal lows here, builds up a lot of liquidity under those lows. No real fair value gap in here. We do have a fair value gap here that does fill here, and the stop will be above this high. Does not fill or stop out, and then we see it run lower on the following day, on the 18th, which is the day we were expecting to see it to go lower anyway. During London Open, nothing really to speak of in Asia this day for fair value gap after an imbalance. We have an imbalance lower, so we have a SIBI, sell side imbalance, buy side inefficiency, fair value gap, beautiful. This is where we would sell it as it hits the top of the candle here, which is the bottom of the gap. Sell it short here. We allow for this much drawdown, but the stop has to be above a swing high, which is here. Initial run objective is we want to see how it trades below this low here for the liquidity. It does that here. Expands down lower. Okay, and then in New York, we see it do what? Fill that entire gap. Okay. When we see this, we expect it to move in our favor again. We want to see it move in our favor. Price does, in fact, trade down in New York Open again. Lower, makes a lower low. And then there's really no fair value gap in here to speak of except for this one here, but it's butt-ended on this low. I don't like that. It's totally something entirely different I haven't taught yet. But this is not, for me, it's not a fair value gap that I would like to trade, because you're right up at the bottom of this area here, in an area where we've created a full fill on a fair value gap. All liquidity now will be resting right above that high. So if it does go higher, it's going to seek that liquidity right there. So this would have probably stopped you out on your position, because we went to first profit back here. So your stop's going to have to drop. In here, if you put it right at the top, right above this high here, it would tag you. So you would have had first profit, but stopped out afterwards. And then we create another fair value gap right in here at the tail end of New York Open. And that gap will be the top of this candle. Let's see if we get a fill. Is 113.01 and 113.01. We fill there. Stop would go here. Relative equal lows. 10 pips below that would be a sweep objective. 129.91. So 129.81 would be objective. Come on. This thing always fights me. Yeah, come on, good grief. There we are. 129.78. So bang, we got it. 10 pips below. Beautiful run 10 pips below to get that for the London close kill zone. And then we move into consolidation the rest of the day, and then we go into Good Friday. So again, you would record all that data and again zoom back out and reference the entire weekly range from every possible entry point, and then record the kill zone, the drawdown, the total available pips, what day of the week it formed on. And this would be your entire week for British pound versus US dollar. And the net results of that you would record. Contrast that with the euro dollar, and then do the same thing with Aussie dollar, and do the same thing with dollar CAD. Then, once you have all that data, you're going to be blown away by the measure of opportunity. Just this simple approach to using institutional order flow. Now, mind you, this isn't a model. This is just price action. That's all I'm doing on Twitter. All I'm doing is trading price action. I'm not using any specific model. Once in a while, I'll toss in the scalping, the free tutorials that I did for scalping. But otherwise, I'm doing what I just showed you right here. And believe me, they all want me to do a signal service. And now you know exactly what I've been doing for 19 months on Twitter. Isn't it fun to be here? This is all I'm doing. I'm picking these setups, but I know the framework around the ones that are really high probability. That's it. That's why you don't see me losing a lot. Some of these are losers, okay? But here's the thing. When there's a loss, when you do this, I want you to spend the most time not counting how many pips you could have made money on. I want you to see where they stopped out, where they lost, and then study those, because that's what you learn to avoid when you do the walk forward. Because you're going to see those same things occurring. And if I tell you what they are, it blows the whole lesson out of the water, and there's no point in you doing it. And you won't appreciate me saying it in words, because you really won't appreciate it. You need to see it. Once you see it, and you see when they fail, the times of the day they are, the days of the week, what has taken place. Did it run out an intra-week high? Did it run out an intra-week low before it did it stop out? Did it run previous week's high or previous week's low? See, they're all characteristics that are going to be very important to understanding what makes these setups, because they're not all high probability, but what makes them high probability. Once you understand that, and you will, when you do the back testing, you'll have an inkling about what it is. Then when you do the forward testing, you'll have new data, and you'll see when you pick the right ones, they're going to have the absence of the characteristics that the losing stop out trades had. And that's all I'm going to say for this week. I did a lot in this presentation, and it may not have felt comfortable. It may not have felt very clear. It may be you still feel a little bewildered and not sure what you're supposed to be doing. Watch it again, because I gave you everything. If you and I were in the same room and I was counseling you and doing a one-on-one session, I would still end it right here. because you know exactly what you're supposed to be doing. Because you would have wrote down, I would have made you write down exactly what I said. And you're just listening. You're not writing it down. Not all of you. Some of you are really writing it down. But I just outlined everything. Now, you're also going to find out when the bias for risk on or risk off is in favor of that setup, they're going to work. Until next time, wish you good luck. Good trading.